This program proudly brought to you by IPO Wealth for the sophisticated investor.
Hello and welcome to Money Talks, where we have a very simple goal, and that is to make you richer. On tonight's show, we work out whether the markets and the global economic outlook is setting us up for a Santa Claus rally. And to do that, we've created a program called The Chartist, The Economist and The Fund Manager. Without any further ado, let's go to the Chartist, Michael Gable from Fairmont Equities and Chief Australia Economist Sarah Hunter from BIS Oxford Economics. Ladies and gentlemen, thanks for joining us on the show.
Thank you.
And Michael, let's kick off with you first, because the charts, to me, when I invest, I always like to think the charts are heading in the right direction. Then I like to think the economy is going to be good. Then I hope fund managers will agree with me. So let's kick off with you first.
Yep.
We've got the S&P 500 chart, because Santa Claus rallies historically start on Wall Street, don't they?
That's right. And when we look at the S&P 500, despite all the noise out there, it's not in a downtrend. Not yet, that's for sure. So the chart that we're going to bring up shortly will show us that since the beginning of the year, the US market has made a higher high and a higher low. So we haven't taken out that low from February yet. So on the S&P 500, it's around that 2600 mark. If we breach that, it starts to get a bit tricky. I think when we do, if we see a breach of that, the market will then go to retest that level. If it fails there a few times, it falls away. That's a negative sign. But at the moment, as I said, despite all the noise, it is still heading higher. So
okay, so it's on the screen now. So the 2,600 is the bottom that you're worried that we might go through. Is that right?
That's correct. So at the beginning of 2018, that was around that 2,600 mark. If we breach that, we start to get nervous, because if we fail to then go back above 2,600 quickly, it tells us that we might be seeing the beginnings of a downtrend.
But Michael, you watch this all the time. At the moment, you're feeling that there's more likely we go up than down from this point in time.
That's right.
Okay, let's go to the Australian one. That's the S&P ASX 200. Is this giving you the feeling that if the Americans go for a Santa Claus rally, which often we see in the second half of December, that we are able to play ball with Santa Claus?
That's correct. So again, despite all the noise, we're down at a very interesting support level. What I've circled in the middle of that chart there is that price range during last year. So as you recall, for about 4 months we traded between about 5,600, 5,800. So we're around those levels now. So that's going to give us very strong support. But one thing to bear in mind is when markets fall away sharply, they don't just resume the uptrend straight away. They usually need a month or two for investors to start to feel positive again, and you often see a retest of those lows. So that's what we're going through at the moment. We fell away during October. We bounced a bit. We're falling away again. We're going to retest those October lows, possibly 5,600 even. I think if we breach 5,600, it starts to get a bit dangerous, but we might see the buying kick in. So we might go to a slightly new low, but I reckon by the time we're about a week away from Christmas, we'll start to head higher again. Particularly,
Michael, I guess you talk about the sort of the more fundamental issue. If there's a Trump-China trade deal, do you think our market and the US market would respond very positively to it?
Yeah, I'm glad you mentioned it. So I think what we might see is a few tweets from Trump just giving the markets a little bit of a few extra leaks along the way.
Okay, quickly, you've got BHP and CBA, because a lot of companies that our viewers watch. Let's take the BHP chart first. Let's hope they can bring that one up. Just tell me what you're saying, because we know they're doing the buyback. We know commodity prices are under a bit of stress at the moment. So what's your feeling before the chart gets up?
At the end of the day, I'm positive on BHP. So the chart we're going to bring up is a very long-term chart. So shorter term, the chart looks a bit messy, but
in fact, we've got CBA, but we'll listen to you and we'll go to the CBA chart.
Okay, so with BHP, it's had a few attempts to get through that $35 level going back 3 or 4 years. At $35 is when you take out the S32 spin-off. So what I've indicated there with the numbers, 1, 2, 3, that's 3 attempts to get through that $35 region. It fell away, and now we're having a 4th attempt. And what you'll notice on the chart is we haven't been sold off very quickly once we got near $35. We're congesting under it, meaning that there is still a lot of underlying strength there. It's a very attractive pattern. When I see that pattern, I get very excited because when you congest under an old...
Those guys are a fun group.
When you congest under an old high, when you do break through that $35 mark, you get a swift move, and I'm expecting a swift move up to $40. Very similar to this time last year, Peter, we're on this desk. BHP was congesting under $30, exact same thing. Got through $30, had a great run.
That's why you buy the back, mate. Quickly go on, I'll go to Sarah now. CBA, what's your view?
I can see further weakness for CBA. So that $70 level was key. It fell under that, bounced. It's rejecting under it again. The old GFC high was 61. I think we're going down there. We need to see capitulation before CBA can get going again.
And it's got a lot of problems with the Royal Commission, what the governors will do with recommendations, and what Labor might do.
Got a list this long.
It's a long list. All right, thanks, Michael. Now, let's go to the economy now, Sarah. So Michael set the case up that the US looks good enough to have a rally. Your view on the US economy?
It's still pretty positive, those underlying fundamentals. I mean, the labour market's still going pretty well. It's got all that fiscal support. And yes, Fed's tightening, but, interest rates are still really very low if you look at their sort of absolute level. So, it's got some good growth momentum. I think there are some headwinds going to come through for the US, but not for another year, maybe 18 months, and more going into 2020 than 2019.
Is the trade war effect having an impact on China's growth, or is China slowing down for other reasons?
Well, that's a good question, actually. So we're seeing it. We're seeing a few signs that it might be coming through. I think the thing with China, though, is the authorities there have been pretty clear that they're going to step in if they feel the need to. So yes, momentum there is slowing, but that's because they want it to, and there's fundamentals there around demographics and things that mean it should do. But the trade war in particular, I think if we start to see some big negatives from that, the authorities are going to do something about that, and they'll offset what they lose in exports, if you like, with some extra stimulus elsewhere. So overall, no, and if that extra stimulus is through infrastructure spending and other investment, actually for our commodities, that can be a really good thing because it drives demand in those markets.
Okay, let's go to the Aussie economy now, and because this is your beat nowadays, being the Chief Australia economist from BIS Oxford Economics. What's your feeling? Because the numbers have been a bit better than you were thinking at the beginning of the year, and a bit better than even I thought. Like the RBA has become more bullish even than me, which seems crazy. And the employment numbers even shocked me as well. They've remained fairly strong, haven't they?
They have, yeah. I mean, they're not as strong as last year, but that's to be expected because last year was so good. A bit patchier. But you're right, growth momentum at the start of this year has been really very strong. I do think it'll slow a bit. Consumers can't keep spending the way they are. The savings rate has dropped quite sharply. Really. Exactly.
Like retailers haven't looked all that impressive, but consumers have obviously been spending on more than just retail.
Yes, services and some spending they've had to do, like utility bills, that sort of thing. But yeah, I mean, I do think we'll see some slowing there. The retail for September quarter wasn't so great, but still, it's pretty positive. And that, housing, talk a lot about housing, as you might imagine.
Well, that's why I want you, because you're not just an economist, you hang out with housing experts.
I do.
The BIS guys have been doing this for a long time. And last time I had Rob Miller on the program, Rob was negative, but he wasn't excessively negative about housing. Have they become more negative?
I think moderately more negative than when he was last with you a couple of months back, but we still fundamentally see that there's support in terms of underlying demand in the housing market in Sydney and in Melbourne in particular. Obviously, that's where we're seeing the biggest downward movements in prices. So, yes, we do think we're going to see more price falls come through, largely as a result of tighter lending conditions, which are just restricting how much people can borrow and so how much they can pay for a house. But people do still seem to want to be transacting, so we don't think it's a crash. We do still think it's a soft landing.
So we've seen predictions, and I think, for example, Shannon Oliver started off at 10 to 15. He's gone now 15 to 20, top to bottom. I suspect you guys think that's still a little bit on the excessive side for Sydney and Melbourne?
Yeah, we'd say so, yeah. Sydney...
10 to 12 or something like that.
Something like that. Maybe Sydney a touch more than that, maybe, but probably, not over 15 is where we are right now. So somewhere in that 10 to 15 mark.
And a lot of Australians don't like the idea of population growth, but population growth has been really important for our economic growth story, hasn't it? So in a sense, it's creating jobs and keeping this economy going pretty well.
It is, and it's also on the demand side as well. More people here living here, they're obviously spending money, so it sort of cuts on both sides, if you like. And yes, from an economic growth perspective, population growth, and if that's through migration or just from more babies being born, either way, it's very, very good for
So it's a fair call to say that the economy should not frustrate a Santa Claus rally if the market can get its act together.
I think that's fair to say, yes.
Yeah, okay. And one last thing, have you guys been able to evaluate the potential effects? And I haven't asked this question, but I know you're brilliant generally, Sarah. The negative gearing, if that came in, have you been able to test that out at this point in time?
Yeah, it's a very hard one to know because it really does depend on what exactly is in the policy, because it's one thing to say get rid of negative gearing, it's quite another to write a precise law and what grandfathering you put in and all of that sort of thing. Yeah. So at the margin it's potentially negative because it obviously affects investors in a negative way. How much of an impact though remains to be seen. We're waiting to get more information from the Labour Party obviously on what exactly they would plan on doing, and then to also get a better feel to see if how likely they are to win the election, which is probably a topic for another night because it's a whole other ball game to be discussing.
Right. Sarah, thanks for joining us, and Michael, once again, thanks for joining us as well. And let's hope you guys are right. If you're not, I might have to remind you in the future. So that was Sarah Hunter from BIS Oxford Economics and Michael Gable from Fairmont Equities. Coming up after break, we have that legendary fund manager Anton Tagliaferro, I nearly forgot his name for a minute, who'd kill me to do that. And I'm really interested to see what he can see Santa Claus rally-wise out there. Welcome back. One manager who's done a lot of hunting for Santa Claus in his time is well-known fund manager Anton Tagliaferro for Investors Mutual. So, Anton, can you hear any jingle bells ringing up there for Australian stocks this
They're very faint, Peter. They're in the distance.
But there are a lot of things challenging our market right now. If you go through the sectors, just quickly run through the sectors that worry you.
Well, I think if you look at the macro thing, obviously we've had US rates going up, we've had obviously the trade war between US and China, we've obviously got a lot of policy uncertainty here in Australia, and I think that's the biggest disappointment, I think, as being a long-term investor in Australia. When you look at the different sectors, obviously, and the government policy that's led to some of the challenges in those sectors.
What government policies worry you?
Well, obviously the NBN's destroyed the profitability of all the landline internet companies, Telstra, TPG, etc. They're all VOCAs, they're all being challenged. If you look at the electricity companies, there's a lot of uncertainty there as to exactly what's going to happen going forward.
There's price interference coming.
Well, there's price interference. Well, there was supply interference because we've banned all future coal generators. There's no gas for gas generators, so there's an issue there. So look, it's very difficult for anybody in the electricity sector. On top of that, obviously, manufacturers are feeling the heat of the higher electricity prices. So, Incitec are talking about closing one of their plants. Orica is saying it's difficult to compete. So, the manufacturing sector.
Are we having problems in the financial sector?
Well, the financial sector, obviously, the Royal Commission, which clearly. Revealed things that were not proper that were going on, but unfortunately it's happened at a time, that's leading to
it's gone a long time,
credit.
And we don't know what the government's going to do, we don't know what Labor's going to do. So it's hard to invest.
What's happened is the banks have stopped lending, as readily, which is hurting the housing sector.
Now, Michael Gable, the chartist, was on earlier, said he thought the charts were saying CBA could go as low as 61. Is that the kind of calculation you're making, or would you be a buyer anywhere between where it is now and 61?
Look, I mean, what's overhanging all the banks? I mean, again, if you look at NAB at 23.50, it hasn't been there for a long time. It's the uncertainty. Obviously, at these levels, on a dividend yield, they look very attractive. But clearly, no one knows what the final Royal Commission report is going to look like when it comes out in February, March. I think both parties are saying they're going to legislate whatever the recommendations are. So, nobody knows what the environment's looking at. And as I said, at the same time, credit is slowing. But look, the banks are a fairly strong organisations and companies, you know, they have upside in terms of cutting costs, whatever, but and becoming more efficient. But look, they've got some challenges. So I think on further weakness from here, the banks probably look like reasonable buying.
Okay, so that's the setting, and it explains why our stock market has been very unimpressive. I think we're at a 4-month low or something at the moment.
Look, I think we're back to where we were over a year ago.
Yeah.
So, look, it's been a struggle. But again, having said that, if we looked at the last reporting season, you know, the results were not that brilliant.
And the underlying economy in terms of growth and job creation is better than what most people expected. It could be better. I know you'll complain about it, but it's still not bad.
I was going to say, Pete, it is, the economy is reasonably strong, but it's extremely competitive. You know, all the sectors are extremely competitive. No matter what the government says about, you know, petrol prices, it's extremely competitive. You talk to accountants.
There's no pricing power, is there?
It's very competitive in many sectors.
Okay, so if the Yanks do have a Santa Claus rally, particularly on the back of a Trump-China trade deal, do you think that we would participate and probably at least get back into the 6,000?
Yes, look, I think, I mean, clearly things haven't changed that much, you know, in terms of interest rates are still low.
Yeah.
The yields available on many stocks are still attractive and fairly sustainable. And I'm not just talking about the banks, I'm talking about lots of other stocks. So, look, there is room potentially for a rally. What's missing is confidence. Yeah. You know, there's a lack of confidence due, A, to what's happening offshore with the trade war, Brexit, etc. And also, as I said, in terms of what's happening here locally.
And Anton, what about the threat of franking credits being taken away from retirees? Are you seeing any lack of interest in those sorts of stocks because retirees think, well, I'm not going to be able to claim a tax refund?
Look, I think it's too early. I mean, no one knows exactly, you know, who's going to be in government, the exact policy, whether there's going to be some cap on franking credits, or maybe a cap of 20,000 or 50,000, whatever. So, in terms of a compromise,
and the Senate might say no to
well, that's right. So it's not a certainty. So I don't think, for example, the banks, which are traditionally the beneficiaries, and I mean, you saw the other day Westpac did a hybrid issue, which there was plenty of demand. So I don't think it's having an impact yet. No.
Okay, right. So what do you like? You've gone through the cautionary tales. Are the stocks out there now that you think really do look well priced? Well,
you know, one which I mentioned before is Crown Casino. We like that.
It's been clobbered as the James.
Well, you know, it was $13 something. It got up to $14, over $14 in August, and it's down to $11.70. So,
and that's linked to China as well.
Well, not really. I mean, so well, yes or no. Look, I mean, Crown's major assets are obviously Melbourne and Perth, which the grind market's a big part of that. You know, they're built, there's no capex to spend, you know, they're very rich in cash flow. Crown's got no debt, and it's building Barangaroo, which, you know, 2021 will open, which I think, you know, looks like it could be a big success.
So Crown's one you like. What else do you like?
Look, Amcor's one that's been clobbered as well. It's been hurt by higher input prices. They have this deal with Bemis going through in the next 6 months, which should be fairly accretive, I think. You know, so that's another good one. Horizon one's that's been you know, beaten up quite a bit because of regulatory uncertainty again. But you'd have to say most of that is in the price. So look, there's pockets of value appearing.
And you roll up your sleeves and had a bit of a battle over Myer recently in the press. Cause a lot of people watching this show may well have bought Myer at very low prices thinking, yeah, either it'll be a takeover or it has to come good. What's your take on what's going on in Myer right now?
Look, it's tough. It's tough in the retail sector, and it's clearly tough for department stores. But I think, you know, Myer now with the leadership they have, they've got a new CEO who's very good, and they're basically going through store by store, floor by floor, rationalising what products they sell. You know, if they sell televisions and they don't make any money, they're getting out of certain lots, and they're handing back floors to landlords. And on top of that, they're trying to get better rent deals going forward. So look, there's a lot going on at Myer. It's clearly tough in retail. Christmas is going to be the key period for them, which I know they're looking forward to. They've done a lot of work. So, look, the brand, Pete, has got substantial value. Yes. You know, they've got 5 million Myer One card holders, members. You know, their online sales are doing better. So it's not all bad, but clearly it's challenging. But I think that the direction they're on now, they're on the way to hopefully turning it around.
And the Solomon Lew play, do you think he's seeing this as the best time for him to get more of the company, or
Yeah, well,
what he's trying to do you think?
Well, he's obviously trying to have influence over the company and at board level in terms of nominating people of his liking.
Yeah.
And the issue with Solomon Lew, and we'd love to work closely with Solly on this because we're both large shareholders. But Solly is a large supplier and is a large competitor of mine, which makes it a little bit harder in terms of him having say on the board in terms of what products they stock, what they hold, what they don't. So that's the biggest challenge we find. So look, but we'll see what will happen.
Okay.
There's the AGM coming up in a couple of weeks, and hopefully the Myer board will, continue the job they're doing now.
Okay, mate.
So
in summary, are we a chance to hear Santa Claus ringing the bell?
Yeah, look, Pete, it's very negative at the moment. The market's really downbeat. As I said, there's a real lack of confidence. But having said that, rates are low, will stay low. Negative sentiment is negative, and I don't think it would take a lot to spark a little bit of a rally.
Thanks,
Not
mate.
a big turnaround, but a bit of a rally.
Great stuff. Thanks, Anton. Anton Tagliaferro from Investors Mutual. Now it's time for a break. On the other side, we look at investing in the fast lane with Anjali Rao.
Coming up on Money Talks, strategies for taking risk out of your portfolio, whether you're invested here or overseas. I'll be speaking with James Mawhinney of IPO Wealth next.
This portion of Money Talks is sponsored by IPO Wealth.
Welcome back. Putting money into the overseas markets can be very rewarding, but also very risky. Here's Anjali Rao with the Managing Director of IPO Wealth, James Mawhinney.
James, it's great to have you with us today.
Thanks, Anjali.
So let's look past the ASX 200 for a moment and talk about investing in overseas. What are the biggest factors that prospective investors would have to consider if they're looking beyond Australian shores?
So I think the first thing, Anjali, is that they need to decide whether or not an international investment is actually part of their investment strategy in the first place. Rather than just getting caught up with what might seem like a good opportunity and ending up burning a lot of money. So it's really important that a decision to invest overseas does align with their broader portfolio decisions. Assuming that is the case, things that they should take into account before even proceeding with the transaction and making sure that they've got the right support around them. A lot of that really comes around taxation, legal advice, obviously, and working with the right accountants. Then, obviously, depending on the type of transaction, whether it's a property-based transaction or a technology-based transaction, they should really try and engage with some local specialists that understand the market. So it's really important to get a really good macro view of the landscape of where they're investing first. They should also then take into account the geographic region that they're investing in. Is it experiencing good GDP growth? Is it not? Is that likely to impact the investment itself? And so what we're finding is that a lot of investments that are made, where they're made in a combination of growing sectors with a growing economy layered over the top, that can actually help produce some pretty extraordinary returns.
So, staying outside the ASX 200 for a minute, let's discuss investing in earlier stage companies. What would be your best de-risking advice for anybody who's looking at them?
So, I think there's a big misunderstanding, and this is where a lot of money gets torn up quite quickly, where a lot of family and friends are often hit up in the early stages of investment saying, hey, put a couple of $1,000s or hundreds of thousands of dollars into this great idea that you've got. Now, without that, the business may never make it to the next stage, but it's important when investors do get involved in earlier stage companies, they have a very clear time frame around requiring a return on that money. They need to know whether or not they expect a cash flow off that investment. A lot of people just think investing is about writing a cheque and hoping the company lists on the New York Stock Exchange in 5 years. It's actually a lot more sophisticated than that. And particularly if you're going to get involved with an earlier stage company, you've got a clear idea as to the timing of the exit strategy, what that exit strategy actually looks like, and then make a decision over whether your investment mechanism allows you to take part in maybe part of that pathway, or in fact the entire pathway, then you get, I think, a much more sophisticated outcome as opposed to just really focusing on, again, writing a cheque and hoping for the best.
Social impact investing is something that we're hearing more and more about these days. Why might investors consider that as a strategy?
Well, in our role as an investment manager, we get pitched projects every day, if not every hour. And with having access to capital, it comes with great responsibility. I consider both to investors and to the social good of the planet, effectively. And so because we get, and people in our equivalent position get pitched new investment opportunities on a regular basis, it's really important we consider that by taking a social impact view, where you have effectively options to deploy that money without a social impact versus those to deploy capital with a social impact, well, assuming the returns are potentially the same, assuming they both bear the similar risks, and assuming you can mitigate those risks as best you can with both types of transactions, the social impact strategy is generally our preference, and it should be, I think, also for a lot of other investors too.
James, fantastic to have your insights today. Thank you so much for being with us.
Thanks, Angela.
That's all for Money Talks, and if you want to know more about investing in income, we have a Switzer incoming investment conference on next week in Sydney and Melbourne. Go to my website, switzer.com.au/event, and you'll see who will be starring in this alternative investment income conference. I'm Peter Switzer. Thanks for watching. I'll see you next week.
This program proudly brought to you by IPO Wealth for the sophisticated investor.